This is Ethan, CFA Charterholder and investment professional, and today I'm going to review QDVO, the Amplify CWP Growth and Income ETF, on 5 key metrics for covered call ETFs: income level, income consistency, long term growth potential, downside protection, and tax efficiency. Then, at the end, I'll show you how it stacks up against other common competitors like JEPQ and Depot. Let's dive in. As I'm recording this, QDVO has only been around about 4 months, so there's no reliable 12-month dividend yield figure to go off of. What we have is their distribution rate and SEC yield, which are quite different. Why? Because the SEC yield doesn't count the covered call income, which is where almost all of QDVO's income comes from. Both of these metrics are deeply flawed, though, in that they only consider the most recent monthly income payment and assume it'll stay exactly the same every month for 12 months, which, of course, they won't. A better indication of what yield you might be able to expect going forward comes from reading the prospectus. They try to generate gross income, that's before expenses, of 0 to 2% from dividends and 4 to 6% from selling call options. So let's call it somewhere around 6%, give or take, minus expenses, which are currently 0.55%, putting a midpoint estimate at around 5.5%. So can we expect that to be consistent? On a month-to-month basis? No, I don't think we can. Here's why. There are 3 basic ways that covered call ETFs manage their calls. Sometimes, like SPYI, manage them specifically to keep the income level consistent month to month. Some, actually most, sell covered calls systematically on some or all of the portfolio, meaning income will be volatile month to month, that it'll always be there and in some cases always be high. And third, what CWP does is sell calls tactically. Basically, the strategy is actively managed, and when volatility is high, they'll sell more options. It's actually on the entire portfolio. If volatility is really low, they might not sell any. It's probably not that likely that they'll go to 0 or 100% options coverage too often, but it can certainly move around quite a bit based on how many of the holdings the portfolio managers decide to sell options on at any given time. Let's move on to long-term growth potential. Even if that's not why you're considering QDVO, it's important to think about because it determines the long-term sustainability of your income. So your income is 7%. Okay, 7% of what? The NAV. And if the NAV is declining over time, your income will be too, even if it stays consistent at the same percentage. Sadly, we can't buy groceries with percentages, so we need a strategy that can grow over time to create a growing income stream that will keep pace with inflation. This is assuming you're taking out all the income, by the way. Obviously, any diversified equity strategy can create a growing income stream if you're reinvesting the dividends and only taking out modest withdrawals. But I know most people unfortunately don't want to do that. Long-term sustainability of income depends on 2 things: volatility and long-term growth potential. Long-term growth potential is important because, of course, if there's money in your account, you can create an income stream, and if there's not, you can't. Simple as that. If you just take out income distributions from your checking account, which is earning you nothing, it's going to run out, right? So you have to have returns that exceed the amount of income you're taking out. But volatility is important too, because mathematically, the more your portfolio goes down, the harder it is to recover. So, for example, if you lose 10%, you don't just need to make 10% to get back to even, you need to make 11.1%. If you lose 50%, you don't just need to make 50% or 51% to get back to even, you need to make 100%. With that in mind, let's dive deeper into QDVO's strategy with a special eye toward long-term growth potential and volatility, and see if that gives us any clues as to how it might perform in the long run. QDVO claims they run a portfolio of 20 to 40 large-cap growth stocks that are relatively balanced across sectors and have historically strong earnings growth and cash flow characteristics. Then, they tactically write covered calls on individual stocks or broad market indexes. Okay, all sounds good so far, but hold on a second. Does this look like a relatively balanced sector allocation to you? More than 40% in tech? There are 9 sectors represented here, out of 11. Imagine your friend was cutting a cake to serve you and your friends, and this is how they sliced it. Would you say good job with those relatively balanced slices? No, you'd probably wonder if they had a little too much to drink. 41% in tech is highly concentrated and not balanced at all. But at least it's more diversified at its security level, right? No, not really. It's got over 50% of its assets in the Magnificent Seven stocks. Then Broadcom, another hot AI stock, then Netflix, a number of the former hot stock group, the FANGs, and then MicroStrategy, which is basically a proxy holding for Bitcoin. So, does this have long term upside potential? Yes, for sure. But is it a low volatility approach? No, absolutely not. It's really not a high dividend approach either. Remember, they said they expected 0 to 2% of the yield to come from dividends? I'd say the way they're allocated, that's much more likely to be close to the 0 than the 2 most of the time. Needless to say, the Mag 7 are not exactly high yielding stocks, seeing as how the Roundhill Magnificent 7 ETF pays out a 0.25% yield. Remember, over half of the portfolio is in the Mag 7 stocks. I personally think it's not that smart of an idea to invest in the hottest areas of the market after they've had a great run. And I also think AI is a little overhyped right now, which I laid out in this video if you're interested. Literally the only clickbaity video we've ever done, which normally would make me cringe, but I sincerely believed it at the time, and I still do, even if my timing ends up being a little early. I'll put that aside for my analysis of QDVO's long-term potential, though. Clearly, investing that way is a high risk, high reward proposition. On the one hand, I do think that the tactical management of the covered calls can help. They intend to sell fewer call options when volatility is low, and that's usually when the market has been going up. And that should allow them to capture more of the long term upside potential in its sustained bull market at the expense of lower income during those times. But on the flip side, they plan to sell more call options when volatility is high, aka generally when the market is falling. Since call options cap your upside but leave you with unlimited downside, they're not really going to help protect you much in a short, quick downturn. We'll get to them more in a minute. And if they sell a lot of call options during the downturn, your income will go up, but they'll miss out a lot on the sharp early recovery. So if I put them all together, I think this will have nice upside potential in long sustained bull markets, especially if they're led by tech or other growth stocks. However, even if I'm wrong about the AI bubble bursting at some point, there will be a market downturn eventually for one reason or another. And when that happens, I think QDVO's ultra high risk profile will put them in a very vulnerable position, followed by a period where they might have a hard time participating as much as you'd expect in the initial recovery. So, for the final verdict on pure long term growth potential, yes, it has it if you're reinvesting the income. But the verdict on long term income sustainability, I'm not so sure. They don't generally write calls on most of their portfolio, which is good. But if their income is in the 6 to 7% range, that's generally considered to be an unsustainable withdrawal rate in the long run. And that's with a portfolio that has more moderate volatility. This is a portfolio that I would expect to have very high volatility. So I think in the long run, like say 20 years or over a couple full market cycles, the strategy has a chance, but is unlikely to be able to create a sustainable, growing income stream over time if you're taking out all the dividends. When it comes to downside protection, I think I've mostly covered it so far, and I can't really show you results since it hasn't been around for any downturns yet. But I'll offer you one little nugget that will help quantify the level of downside protection it's claiming. Here on their fact sheet, they say the covered calls and dividends may help reduce volatility versus the overall market during times of broad based market declines. Yes, that is true, but they'll reduce volatility in a market decline much in the same way that if Elon Musk picked up a penny on the street, it would increase his wealth. Technically true, but you're probably not going to feel the impact that much. Dividends do provide some downside protection in most market environments, all else equal, but like we saw, this is really not a high dividend portfolio. Its stocks almost certainly yield less in the S&P 500, given that half are in the Mag 7 and it only picks stocks from the Russell 1000 Growth Index, most of which don't yield very much. The only downside protection from covered calls comes from the income they provide each month. So there are two things to think about here. How much is that? And are you taking out the income? They aim to provide 4 to 6% yield per year from covered calls. So if we take the max, 6%, that would be about 0.5% per month in income from the covered calls. So if the stocks in the portfolio fall 10% in a month, the income from covered calls would reduce that loss to 9.5%. Not that much downside protection. They would make more of a difference if it was a slow, gradual decline, like if the market fell 1% every month for a year, but that's just not how market downturns happen in reality. Something happens, everyone freaks out, and they all sell at the same time. Then there's the question of whether you're taking out the income, because if you are, you kind of don't really get that downside protection. Let's say you have $1,000 invested in QDVO. The market and QDVO stocks go down 2% in a month. Between its covered calls and dividends, it pays out 0.6%. So the total return of the fund, which assumes dividends are reinvested, would only be at minus 1.4% in a minus 2% market, aka downside protection. But if you took out the dividend, the value of your QDVO investment would still be down the full 2%. You'd have income that month, but then in the future, you'd only be earning your 5 or 6% yield on a base of $980, not $1,000. So it doesn't really invest in a high dividend portfolio. It offers very little downside protection from covered calls, and it's highly concentrated, which adds volatility and downside risk. When it comes to tax efficiency, the short answer is I wouldn't expect it to be very tax efficient. The two primary sources of return are stock price appreciation and the premiums from the call options. The stock part may or may not be taxed at the favorable long-term capital gains rate depending on how long the ETF held each of the stocks that it sold. And the call options are generally held for less than a month, so that income will be at the short-term capital gains rate. That's the same rate as your income taxes. Dividends from the stocks in the portfolio receive a favorable tax treatment similar to long-term capital gains, but these are a very small portion of the total return in this fund. So time will tell, but I would estimate this to be more tax efficient than an ETF that caps more of its outside with covered calls and generates most of its returns from the call premiums, but less tax efficient than an income ETF that gets all of its returns from stocks. And that brings us to a quick word on how QDVO stacks up against a few ETFs that I'm often asked to compare it to. First, people ask if this takes the same approach as Devo. No, it doesn't. We put out a video a couple months ago singing Devo's praises, but there are a few key differences here. The things I liked about Devo were its balance among sectors and its dividend-oriented portfolio. QDVO claims to have those things, but it really doesn't. Since QDVO invests in more volatile stocks, it gets more income from covered calls. But since it invests in lower dividend paying companies, it gets less from stock dividends. Based on the prospectus ranges and the income they say they expect to generate in each, they're telling you to expect QDVO's income to only be about 0.5% higher than Devo's. But yet, more of that will come from covered calls, so it will likely be less tax efficient, and it comes with a much riskier portfolio. Remember, for long-term stability of income, volatility is very important and, in my opinion, underappreciated in the covered call ETF community. For these reasons, I much prefer Devo over QDVO. Compared to JEPQ, which is the most popular tech-heavy high-income covered call ETF, I prefer QDVO. It doesn't cap its upside as much with covered calls, which likely will make its income more sustainable in the long run, despite being lower. I'm not sure if QDVOs will be sustainable, but I'm highly confident that JETQs will not be. Since QDVO doesn't cap as much of its return with covered calls, it gets more of its total return from stock price appreciation, which might make it more tax efficient. Both of them are far too concentrated in the Mag 7 for an income investment, in my opinion, but QDVO is even more concentrated there than JETQ. To me, a point against QDVO, but for you, it might be a point for it. Like everything on this channel, this isn't advice, just education. And if you feel like you've learned something or this video has helped you make a more informed decision, please hit those like and subscribe buttons and leave a comment with what you'd like us to cover next. Also, if you want to connect with my partner Cal and I directly, you can do so by clicking the link in the description to join our Discord, which is free as I'm recording this, but may not be for much longer. Thanks for watching, and I'll see you in the next one.